Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Friday, June 4th, 2021. I'm going to start this one out a little bit different, just do a quick update on the dollar and gold, not spend a lot of time there, and then talk about the broad market. Again, a quick update. I want to look at just point out some of the internal, some of the things that I'm watching, and then an update on a few of the trade ideas that have been recently highlighted. So we'll go through in that order, starting out here with DX, the US dollar future. Okay, so I posted an update earlier, so not much to discuss here. This is pretty good support down here, about 89,659. Case was made for recently for a bounce in the dollar. We're coming off a divergent low. That means positive divergence. Prices making lower lows, indicators making higher lows. Just like you had the divergent high here, and that was the catalyst for this correction with the sell signal right there. Divergent high drop, divergent low rally, and divergent low breakout and rally. Now what I wanted to point out is the drop today, and there's something I always point out in trading. There's a big difference between a big move in a security that just happens randomly, and I attribute that to just being noise. In other words, nothing goes straight up forever. And there's also a big difference between a big move in a security, a stock, an ETF, an index, that is a breakout, technical breakout. For example, you want to see that on a bullish chart pattern, and you get a breakout, let's say above that bullish chart pattern. Ideally, you want to see it on above average volume. I like to see 1.5 times or better than the average volume for the past 60, 90, or 100 days. Depending on what charting platform you're using, they'll give you those statistics. And it's not an absolute must, but from my experience, breakouts that occur impulsively with big moves and on high volume have a much better rate of sticking. Now, the point I'm trying to make today is this quick swoon down in the dollar, and it really doesn't, it hasn't changed anything technically. Here was the last breakout. This downtrend line goes to the left of the chart here, but there was our downtrend line. We broke out, we rallied, and then look, we had an equally, if not sharper, drop there, and it didn't do anything to stop the trend. This was a breakout, and we were in early stages, identified in advance back at the time because of this divergent low in the breakout. We were in the early stages of an uptrend, and there it was. It lasted with one wave up, or one leg, a corrective wave, wave two. Wave 1, 2, 3, 4, 5. It was a 5-wave up, and then we hit a divergent high, and we had a little trend line here, right there. It's not on the chart that was broken. There was a correction, divergent low. So you get the point. There was a wave 1, 2, 3, 4, 5. And now we're all we are. And we don't have to have, that may not fit the perfect wave count for you Elliott statisticians. That means people that use Elliott wave theory to count the wave cycles. Typically the third wave is supposed to be the longest, so I can just tell you offhand that's not a textbook 5-wave move in Elliott wave. But either way, point being, this didn't take out anything. We still have a series of higher highs and lower lows. And so when does it start to affect things? Well, certainly if we come back down and take out that support that the case was made to go long at. But as of now, I think the most likely scenario is I think that's a buying op for the dollar. If you were already long, you want to add to it, or if you weren't long, you take a long shot there with a stop not below too far below support. Minimum target still 98.33, and then the next stop up here is the target zone. So that's that. And as I said this morning, it was anything but mere coincidence. You had a sharp reversal in the dollar. At the very same time, you had a sharp reversal in gold. Now, gold hit this trend line. We had a breakdown here of the minor trend line. That's why this one is thicker and more prominent. That's the primary trend line on the 60-minute chart. So we had a breakdown, back test. Then we broke the first support level at 1891 or so, had an impulsive drop, hit that first target or horizontal support at 1876, had a reaction, back tested it from below. If you can see here, I'll have to maybe zoom in on that a little bit. There it was. This is how it played out. Let me go to a candlestick chart. Nope, that is volume, not what I was trying to do. There's candlesticks right there. There it is. So we broke down, back tested, and then boom, hit the trend line. So this bounce is to be expected. That's the first tag in a long time of that trend line. And as I often say, the initial tag of a support level from above And when I say initial, not the very first, or it wouldn't be a level. We wouldn't have support if there weren't other tags. I'm referring to the first tag in a while often produces a reaction. So there it was. This is the very same moment gold hit the trend line in reverse. The dollar also reversed. And in this case, they both were it coincided with the employment data report this morning, and that is not mere coincidence either. The charts and the fundamentals will often align with each other, and that's it. Is it over? No, I don't think so. Based on the scope of this divergent high, I think we'll probably get some more pressure in gold. In fact, this is an objective shorting up. As I mentioned this morning, we're kicked back to about 1892 is roughly that level there. That's former support, now resistance. And we overshot it by a hair. Well, there's a lot of momentum to carry gold up there. So most likely, I think we'll make another run at it. And being that we've already tagged the trend line once, we could break that, and that would take us down to 1847 or 1848 or so. Again, the trend in gold has been very strong. So, I'm more inclined to go long the dollar and instead of short gold, although you can do both. And if nothing else, like I said, it's just time to, saying that back here, maybe not be adding to gold position, gold longs. And of course, GDX, obviously, when gold fell, GDX took it on the chin. I'm going to get to AMC in just a second there, just show you what happened with GDX. Big drop down when gold dropped down and hit that trend line support, and then obviously a pretty big, good sized bounce so far. That's a 60-minute chart. Here's what it looks like on the daily chart. Boom, there it is. And keep in mind, the GDX also fell down below that trading range right there, and we're back testing the trading range from below. So that's why we may get another thrust down in the metals and miners here. My convictions aren't super high, but that's still the way I'm leaning, and figure that's the most likely outcome. Okay, let's now go to the equity markets. Let's start there. Big reversal again, based on it happened this morning after the employment numbers were released. Gunned NQ. This is the Nasdaq 100 Futures 60-minute chart. Remember, yesterday we took out that trend line, gave us a sell signal in NQ, and rallied up. We're right back to the top of the recent trading range. In fact, we're exactly right about where that previous divergent high was, and maybe even a hair higher. So that we moved the needles. It's just like football, you get first down, and they move the first down markers, and you get another 10 yards to go before the next first down. And that's it. So we move the marker, we move that divergent high, and now at this point, it's even larger divergence than we had in place before right there. So it'll be to be continued, TBC, because this is the end of the week. It's Friday, and there's only another about 40 minutes or so in trading left in the trading session. So we'll just have to pick up and see where we pick up next week on Monday morning when the market opens. Okay, so let's what I'm going to do is roll into some trade ideas next, update on some recently highlighted trade ideas, and include an update on AMC. Before I do that, we're going to talk just real quickly about the what's going on in the market, particularly the Nasdaq 100. Again, that's been my focus. I've been watching the SPY, the S&P 500, but as I said, until we see financials and industrials break, there's no way to get aggressively short or to make a very strong case for a correction, because those two are still holding above trend. Those two sectors, those significant sectors, but we continue to see weakness. Tech topped all the way back here in April, and we're still well below that. When I say tech, because the Nasdaq 100 is over 50% technology companies, it lacks other key sectors like financials and everything else. So it's almost a perfect mirror of XLF, or XLK, I'm sorry, the technology ETF. All right, let's just talk about market internals, what's going on there. And I'm going to pull up this. We're going to start here with this one. This is the NASDAQ Composite. Up top, you have the NASDAQ Composite Index, and on the bottom, you have the, I'm sorry, take that back. I was changing colors on my pointer. Up top, that's the NAAD, which is the NASDAQ Advanced Decline line. It tells you right here. And down below we have the NASDAQ composite. All right, so what I look for, this is one measure of market breadth when they talk about the internals. So you're looking at the number of stocks advancing in the NASDAQ versus the number declining. And what I look for is down here when the NASDAQ's going up, like it was heading into the Great Bear Market, the Great Recession back in 2007 when it topped in October 07, bottomed in 09, 50+% drop. You could see we had divergences building up into that point. All right, sorry, I had a phone call I had to take there. Anyway, so you can see, when you're diverging, when the number of when the AD line is falling, fewer and fewer shares advancing, yet the market's still going up, then that's a sign of a deterioration in the internals. And then you can see usually the bigger the divergences, just like anything else, the bigger the ensuing drop. And then along the way, you get these little, periods where you get the divergences, and all these red boxes show you the corrections that came after the divergences that are all marked above. And as I point out here as well, see these green lines? That's a healthy market when you have both the stock market going up, or an index, and the number of the AD line, the number of advancers versus decliners going up as well. So here's what I wanted to point out. Just lately, the last time we had divergence was leading up to that 36% drop into the COVID highs right there. I don't know why it's not box red. I covered at the time, but that should be a red box. And here we are. So we have those divergences. I'm going to say this: the internals are much more healthy on the S&P 500 and the NYSE. This is isolated so far. It has been isolated to mostly to the NASDAQ and tech. Again, maybe it's consolidation in those stocks, maybe rotation that'll prove to be healthy. But I'm just pointing this out. Take it for what it's worth, and this helps to formulate, my outlook. And it's again, when the leading sector, that's the thing. We're not looking at the the REIT sector, real estate investment trusts, or the utilities, or some sector that doesn't even move the needle on the S&P 500. Those are components. So they're two of the 11 sectors in the S&P 500, but they each represent about a 3% weighting, whereas tech makes up over 25% of the returns of the S&P 500. So that's that. I'll show you a couple more, and then we'll move on. I don't want to beat a dead horse, but I do want to point these out. You also have the, let's see, we'll look at the NAHLR is one I wanted to show you. I've got a ton of them down here. This one should work if it's the chart I want. Yep, so this one's similar. This is the, let me move it up where you can see it on the screen, the NASDAQ new high to new low ratio. So not the advancers versus decliners, but those making new highs, 52-week highs versus 52-week lows. And same thing, I didn't zoom out. You had, leading up to that, you had divergence before the big bear market back after the dot-com bubble. I made the mistake of not putting this chart here on the NASDAQ composite down below on log scaling. So what happens is that was a 50+% drop. These were only like 25, I think, 21, 26%, and they look bigger. They're not, because this is not log scaling. Otherwise, you would see the scope of this drop here much larger. Point being, again, look for these divergences, and after the divergences, I don't know if you can make out these dashed lines. That's where the divergences happen, then the correction ensued. Divergence, divergence, correction. Divergences are not timing indicators. They're just a warning of conditions going on in the market. I will say this is a relatively small divergence, at least over a small period of time, but the divergence itself is pretty steep. Look at these lines. Look at the angle. This is the steepness or the slope of the divergence line up top. So again, something to note, and it's just saying that all is not well under the hood, even though the NASDAQ is not far off the all-time highs. I told you it peaked back in late April. When you look at it here, it looks almost an equal high in prices, and that's why I have that divergence drawn. But you can see a sharp drop off in the new highs to new low ratio. And then one more I'll show you. That's again another measure of breadth indicator. I'm again focusing on the NASDAQ right now. And I gave you that caveat that the S&P is looking better, but NAA50R, let me find that one. I've got it in many forms here. Let me see if this is the right one I wanted to show you. This one will work. Again, I'll when I started this chart years ago, I didn't make this in log scale, which I should. Up top is the NDX. Let me turn on my arrow tool. NASDAQ 100, down below the percentage of stocks trading above their 50-day moving average. That's what the NAA 50R is on this program. This is stockcharts.com. Okay, here's a great example. You probably can't make this out, but I measured these corrections that came. There was a divergent high, a divergence between the NAAR and the NAA 50R and the NASDAQ 100. That was a 15% drop right here, but it's almost immeasurable in this because I didn't have this in log scale. Otherwise, I would put it in perspective. That was a 56% drop right here in the bear market of 2007 to 2009. So my point is, all these corrections are measured: 9%, 9, 16, 17, 6, 11, 10, 25, 30%. Those are all corrections measured that came after divergences between the NASDAQ 100, meaning it was going up, and then all of a sudden you started to see divergence with the percentage of stocks trading above their 50-day moving average falling. And so here we are, full circle, and this one's pretty steep. We started at this point right here. Remember this? Let me see if I can make this a little bigger, and you can make it out in the video a little more clearly. All right, so here, this is the best I can do, I think, right here. Now let me pause that. Okay, that should zoom it in close enough so you can see. So this point right here, actually, this is when we started to diverge. You can see we peaked out in the indicators, the percent of stocks trading above their 50-day moving average. We made a lower peak up to this point. We had a correction, so it's not as if the divergences didn't pan out for a correction. But what happened? We went on to make another high and yet another high in the NASDAQ up top. And this is extended divergence where you can really see the line dropping off here. So I wanted to point those out. And again, they're showing, that there's very poor internals over the last few months in the NASDAQ 100. And the fact we're seeing this unusual divergence. It's usually the leading index, meaning it goes up more in a bull run than the S&P 500. And because they're higher growth companies. Again, we're not seeing that. Everything's a little quirky since COVID. Keep in mind there's a lot of the reinflation trade. The companies that got priced for death, like airlines and restaurants and cruise ships, hospitality companies, they're certainly coming up more. And again, these are different times, and it would be more of a red flag if we had comparable divergences on the S&P 500. But with that being said, it is still, we'll call it a yellow flag, if you will, a caution flag here. Okay, the rest of the video I'm going to update some of the trade ideas that I highlighted recently. And what I'm going to do, because I'm contrary by nature, today's an up day in the market. It's a pretty strong day, especially in the NASDAQ. So I'm going to highlight some of the short trade ideas. I'm going to tell you why. As you know, if you follow me for years, I always try to keep a mix of long and short trade ideas at any given time for both traders looking for different opportunities, and especially in a choppy market, because although the market's holding up with the S&P near all-time highs and the NASDAQ not too far off those, it's been going kind of sloppy and sideways now for, as I pointed out recently, for months. So I'm going to talk about this. The other day I found this article talking about AMC shorts, and this is not what I'm really not wanting to talk about AMC. I am going to give you an update on that. But what it talks about is how the hedge funds, the professionals, the institutions are hanging tight. With GameStop, they did get smoked, and a couple of hedge funds actually blew up from that. They were squeezed out, and the Reddit group, they got them. They were successful. They're trying to engineer the same thing, but this article went on to say how it's a little bit different now. And I'm a big believer that the hedge funds, those are the professionals on Wall Street. They're the pros, and it's that whole fool me once thing, shame on you, fool me twice, shame on me. So I really doubt they're going to get cooked. I mean, again, if you go in and read up on social media, these AMC guys, they're calling themselves the apes, from Planet of the Apes. The apes band together and beat the humans and fight them back and all that. And they're claiming the short squeeze hasn't even begun. They're talking this thing going up $100, $200 and above is where they think it's going, and they're hanging tight. But again, let's get off that for a second. The gist of the article, the takeaway that I had, is that the the professionals are now boosting their bearish wagers, and they're talking about how their short positions against single shares, meaning individual stocks, climb for the ninth straight week, reaching almost a one-year high relative to the overall equity holdings. And so what's going on here is they're talking about, I'll just skip ahead. So they're looking at a group of the most heavily shorted stocks. That's information Goldman can get here. And what they're talking about, that group of I believe it's the 50 most heavily shorted stocks, is up over the period of time they're talking last quarter or so. It's up 2.4%. And you're saying, well, how are they making money if stocks are up 2.4% and they're short? Versus an advance of 6% for the S&P 500. That means that any gains for a trade that's short individual companies and long the broader market. I'm sorry if I didn't say that correctly. So that's what a lot of hedge funds and institutions will do, and that's often why I trade a long-short portfolio, especially at times like this. Because you can actually make money. You can make money if you pick the best looking shorts or most bearish stocks, and you either can be long the broad market. Maybe you're not an active trader, you're just trying to hedge up to your S&P 500 index fund or whatever you have there, or you're trying to trade the most bullish stocks long and the most bearish short. And so it went on to say what I've been saying recently, that this is becoming most likely, and we'll continue to see a stock pickers market. And I believe that the stock market is very overvalued. Yes, the economy is coming back online, vaccines, the shortage, job openings everywhere. But how much of that's been priced in the huge run? And that's why the market's stalling out. So I believe in this, that we're going to see the S&P at best trade mostly sideways. It doesn't mean we can't go 3-5% higher, 6, but mostly sideways. And then that makes it a stock picker's market. And so that's when we'll roll into these trade ideas, because you might be saying the market's up, it's at all-time high, why do you keep showing shorts? I've showed plenty of longs lately, and we're just going to focus on the shorts today, and then next week I'll do an update on some of the long trade ideas that I've been highlighting recently. All right, so let's grab here's a couple charts that I shared earlier today with some people on trading the stock, and this is it. We're in this range. We have the recent highs. I'll tell you one thing, my read on this, the momentum stalling out. That could be consolidation, but when the buyers dry up, when the last Reddit bull has bought his or her last share, and I'm metaphorically speaking, that's it. This thing's going to crater, because that's the institutions are not buying this valueless stock. That one analyst has this thing at worth zero based on their debt load and other fundamental issues that they're facing. So what's keeping it up are these Reddit apes, they call themselves, or whatever, the bulls trying to buy this right now. And so here are my levels, about $69, give or take those recent highs, and then this trend line. Break below the trend line would be bearish, break above that should be bullish, and that was earlier today. And we since hit the trend line. We're right on it. This was at about 2 o'clock, and now here's where we're at. We broke down. So here's the tough part. It's less than an hour, about 15, 16 minutes to go before the close, but that is a breakdown of back test. Friday, I personally don't like taking positions at the end of the day, especially even breakouts, because they have a higher failure rate if they come right before the close. But if you want to take it on face value, that is what it is. So again, this will be to be continued Monday morning, whether we get a little more downside. Who knows what happens in the last 15 minutes. We could recover. But as of now, we're below that trend line. And again, that should open the door to that 322-ish target. I also have two targets here. about, call it about 37.40 would be my first target, and then 32.30 right there. So that's AMC, and then again, longer term targets still remain. I think this one, once this move is up, and again, it's a parabolic run, and the momentum has stalled out. So that's probably the end of run, in my opinion. We'll see. And I think this one comes back down, all the way back down here at about at least the $9 area in the coming days to weeks. But don't touch it with a 10-foot pole unless you are a very aggressive trader, and even then, just put your play money, your Vegas money into it if you're going to take it. Let's talk about a few other trade ideas, and I will wrap this video up. Again, these are some of the recently highlighted trade ideas over the last few weeks, a few months. Bitcoin, I told you the futures back here broke a major long-term uptrend line. Gave you a sell signal here months ago, back in February, right after it topped. Sell signal there, calling it down to T1 and T2. We hit my first target zone right there, hit the bottom of the first target zone, hit the first target zone again, hit it again, finally broke down. That was the next sell signal I gave, and said that should open a door for a move down to T2, which was hit almost perfectly right there, and we've been consolidating since. When we got close to that, I added a third target, which I still think we get to. It seems to me the crypto bubble may have burst. The very least, that's a heck of a correction so far. 50% or so drop in Bitcoin. And again, my point is I still favor more downside, potential bullish crossover there. And the next sell signal or objective short will be a break of the below the 28.15ish level. A couple others I highlighted recently: SIG, Signet Jewelers. Again, these are short stocks, short trade ideas. And you're looking at a market that's going up, but some of these stocks are breaking down. And like I said, this is a way to either a pure play short trade or a hedge against long positions. Or if you are long and you happen to be in any of these stocks, this is where you might want to consider stop outs. You had a breakdown and a back test. At this point, we need to take out these recent lows. And that should open the door to at least these. These would be my preferred targets right now, down to about 41.12. Next up, Hertz is kind of stalling out. I mentioned the Q and HTZ GQ. I mean, this is a bankrupt company. This is another one of those meme stocks like GameStop and AMC, and it's stalling out here where I expected to at resistance. That was big resistance there, or pretty good resistance, I should say, about 640. And I had a minimum pullback to this uptrend line, but so far we're just consolidating, and ultimately probably come all the way back down here. This thing should be worthless. Tupperware, TUP. There's been a lot of trading ops on this one. I highlighted it way back here somewhere in this trading range, and saying you go long at the bottom of the range, up to the top, go short, swing, wash, rinse, repeat. And the last time I highlighted it was a short trading up here both days, 2 days in a row, or three, if not three. We were at the top of the range, and if you took a short on any of those days, it was highlighted from that top. We're already down about 17%, so made, with more to go, because my target would be once again at minimum the bottom of the range, which is about $23. Next up would be Peloton. Peloton, mentioned that as a short, oh gosh, I can't even remember first where, but most recently right here where I said we kicked back to this gap right there. It's a resistance zone. That was a gap from this day. Hit the bottom of the gap, so far turned down, so that was highlighted there. If you shorted that one, you're good for about a 10% gain so far. That's how much it's reversed. And it also took out the trend line. Next target is still $72 on that one, so there's plenty of meat left on the bone, in my opinion, on that one. So this is another example of a stock of how you can trade individual stocks and beat the market even if you're short in a bull market, because here's a stock clearly in a downtrend. A downtrend, again, is simply defined as a stock making a series of higher or lower highs and lower lows. So once we take out this previous low, that's going to keep that downtrend intact and should clearly open the door to that $72 price target, which is about another 30% below. BC, highlighted that as a break, objective short entry on a break of this trend line. That's what you got right there. You had a little kickback rally, and so far it's down about 6-7%. Coming up on my first target there. at about 94.53. Might want to cover a little bit above that. And I'm going to add the second target. I'm going to make it a zone because I see some support right here in that reaction high. So let's just say the next target's 73.64. You always cover a little bit below the actual, or a little bit above the actual support level. Ally Financial, just waiting. Look at this beautiful uptrend line. This is a setup, untriggered. Break that trend line. My minimum target and first target's 42.68. Again, this is one of the financials, and the financials are holding up. And I talked about this before. The odds, if this one broke down tomorrow, the odds would still be, you could still hit the target, but they would greatly increase if XLF, the financials ETF, breaks down as well. So keep that in mind, but certainly one to watch. I already covered AMC. XBI covered way back here, broke trend line supports, been moving lower. Then you had a break of the 139.59, but we hit this long-standing support / target right here, 122.43. We've been consolidating, but why I wanted to highlight it, number one, okay, it should provide an objective short on a break of the recent lows or a solid move back below that 122-ish level there. But also, if you can make it out here, I have a confluence of moving averages. If you can't see them, I have the colors turned down a bit. There's the 200-day exponential moving average. There's the 200-day simple moving average right above it. And this yellow line here coming down and about to cross is the 50-day exponential moving average, key moving averages. So you're pinched between a confluence of key moving averages and you're below them, and that's typically bearish. If the 50 crosses down below the 200-day moving averages, you get what they call that a death cross. And again, I have those levels turned down now, but we crossed below them all here, and that's what happened when we dropped below the 200-day moving averages. We had that big correction. We also dropped below them there, back tested the 200 days, and fell. So typically it's bullish when you're above. I'm just going to draw over where the 200 days are. The simple and exponential are right next to each other. That's where they are. So you can see bullish when above, bearish when below, and that's what the biotechs look like. It's not what I'd short right now. You could, but it's consolidating, and it's probably not going to run down to that next target until the rest of the market takes another leg down or takes a leg down. 108, it would be that next target. WGO, Winnebago, mentioned this as a potential complex head and shoulders pattern with two right shoulders. There's your neckline. Well, first of all, I mentioned it here on a break of this trend line as an objective short. From there, since it broke the trend line, it did fall, hit that 66.58 target for about a 17-18% drop. Came very close to it, I should say, just a hair above. And that's why you always want to cover short just above actual support. And then this is the neckline for the potential head and shoulders pattern breakdown, back test, and an impulsive rejection so far. And that would be the measured target for the head and shoulders patterns right about here, right in the middle of this support zone, target zone that runs from about 60.90 down to about 58.70. And last but not least, Marathon Digital Holdings. This is a Bitcoin proxy, and mentioned back then when Bitcoin broke down or shortly after, and then again on a break here below the 28, about 29 support level, and it came up and it made a near back test, and we're also back testing this downtrend line right here. So this one I still think comes down to at least 16.15 and or that uptrend line, and quite possibly more. I'm going to wrap it up here, and I just realized the video is not going to get out to you guys till after the close, so no. I'll get it out to you. And again, there's nothing really actionable for right now. We're heading into the weekend, so you can watch this one whenever you want, and we'll pick it up on Monday, and then I'll go over some long side trade ideas then as well. This has been Randy Finney with Right Side of the Chart. Have a great weekend.